folks, it's Matt Hayson here, and we are back with the word for 2026. And this year, I'll again be looking very closely at everything impacting Sydney's property market. As always, it will be real, sometimes uncomfortable, and even occasionally controversial. But I can tell you, it will always be grounded in what we are seeing on the ground, not theory, and certainly not noise. Now, January has kicked off with genuine activity. We've seen very strong numbers through our open homes, with some properties drawing in more than 40 groups through the door in their opening week. Now, there's been new energy, curiosity, and some solid sales achieved, concluded within weeks of being listed. So that's some pretty good news. But let's be clear, was this the strongest opening to a year we've seen? No, it wasn't. This market is still a direct reflection of the broader economy, both macro and micro. Uncertainty is certainly evident. There's an eye on global affairs, there's an eye on the cash rate, there's an eye on the rising volume of listings coming to market through February. Layered over all of this is the modern distraction. Everybody knows it. It's called social media, where everyone suddenly has an informed view on economics, global politics, or property forecasting after watching a few short clips online. The problem is those messages often collide, they conflict, and the decision making can become quite messy. At an agent level, we see this very much daily. Buyers believe they're now the expert negotiators. Sellers believe that they know how to line up their sale campaign better than anybody, and that's fine, but let's add some perspective. I can tell you, a mediocre real estate agent is around 10 years in the game. A good, consistent agent after 15 years, maybe they can call themselves advanced, and after 20 years plus, maybe then you can claim some expertise. An hour or two on social media hasn't even scratched the surface of the nuance of operating through the property market. Our role is to bring you clarity, clear detail, clear insights, and the reality checks on what's actually happening and how to navigate the current market conditions. Now, let's take a look at where this market truly sits, because Sydney dwelling values, they increased by 0.2% in January, according to Cotality, barely a shift from late last year. And frankly, that's exactly how it feels on the ground in terms of buyer engagement and overall sentiment. Yes, interest rates, they have gone up. Australia is now the first advanced economy to lift rates from 3.6 to 3.85%. Consumers saw this coming. The Reserve Bank didn't, the government didn't, and the banks didn't. Now that tells you something very, very important. The takeaway here is, in our view, very simple. Never hold out for the promise of forecasts from our institutions. Their body of work since 2020, when tracked honestly, reads more like a thriller than reliable guidance. Now, what history does tell us is that rates go up, rates go down, property continues to trade, and markets, they move in cycles. Now, my view is that 2026 looks like a broadly flat year for growth. We could see some pockets of further increases, but buyers are already borrowing at absolute capacity levels, and there's only so far wages can stretch. Now, the very best homes in each and every market will continue to still produce outstanding results. They always do, but most properties are often compromised in some way, and that naturally caps buyer interest and value. If we then add in the broader economic picture, the challenges become quite clear. The Reserve Bank is now signalling that real wages may not go up until later in 2027. Inflation is also tipped to reach 4.2% later this year, after we were told last year that inflation was, of course, under control, yet everyday essentials continue to rise. Now, that erosion of trust really does matter, because consumer confidence is fragile, and it's likely that discretionary spending is going to pull back. Now, the early auction results reflect this caution. SQM research shows that Sydney recorded just a 48.8% clearance rate from 576 auctions last week in Sydney. That's subdued, but here's the balance. Buyer numbers are there, finance is in place, money is still flowing, but what's changed is this behaviour. Buyers are cautious, they're deliberate and very responsible. They're not chasing the market. And that brings us to sellers, folks. And this market, I can tell you, will absolutely punish above market expectations quickly. Buyers will simply move on. Now, we're not staring down major price declines, but we're also not in a rising tide either. So if you're moving due to a lifestyle change, relocation, upsizing, downsizing, activity is very much there, but it's realism and execution around your campaign that matter more than ever. Now, one final point that's worth noting this week, we learned that Treasury is providing the Reserve Bank with spending data that materially understates what's actually occurring. Now, this distortion feeds directly into how inflation is being read, how forecasts are being formed, and how policy decisions are being made. Now, this system becomes very messy, and the people who carry the costs are everyday Australians. When the data is poor at the source, every forecast that's built on top of it becomes unreliable. And that's why relying on headlines or these institutional promises is very dangerous. The only sensible approach right now is to focus on your own position, your own timing, and your decisions that are grounded in reality and what you're seeing in the market. And that's exactly what we're going to continue to do here at The Word and at CH. So that's our wrap for 2026. That's our first one, and I look forward to catching you all next week.